With regard to central securities depository, one of the characteristics is that there should be safe custody and safekeeping, and even transfer should be very, very straightforward. So there shouldn't be instances where your securities are lost, particularly in a depository. Then this really will be the gist of our discussion, because we'll be looking at trading systems and clearing systems. And if you'll allow me to read, with regard to general business and operational risk management, systems should be designed to ensure a high degree of security and operational reliability, and should have adequate scalable capacity. Business continuity management should aim for timely recovery of operations and fulfillment of financial market infrastructure obligations, including in the event of a wide-scale or major disruption. There's a requirement that even if you negotiate trades, you need to report it in an infrastructure so that there's what we call post-trade data available to realize price transparency on the following day of trade. So in OTC platforms, I think there has also been a directive from the EU around OTC derivatives. They need to be reported in a platform to ensure, even though these are not formal transactions, there's a need to have them reported to ensure transparency. So we've been able to see initiatives undertaken by the two CSDs, that is the central bank CDSC that handles treasury bonds, and the CDSC that handles equity and corporate bonds. And in 2015, we were able to see a major milestone when settlement was upgraded to central bank money as opposed to the previous commercial bank money. In commercial bank money, effectively the central bank had agreed with 4 settlement banks to be the ones clearing or making the payments. But there was a risk associated with that, and I think it was a very big milestone to have an arrangement where, even though that the cash leg is through the central bank money, of course through the central bank, securities are still through the CDSC. Ideal situation is where there's what we call a true DVP, or delivery versus payment, where cash simultaneously exchanges with securities. So it's effectively T plus 0. But this is one step towards that route. Then there's still fear around recession, and perhaps I'll differentiate that from depression. Recession is normally around 2 quarters of contraction of growth, as opposed to depression that would take a much, much longer time. So there are fears of recession in the US economy, and there are telltale signs. We have seen the lowest level of unemployment in the US since the global financial crisis of 3.4%. And the other factor which cannot be ignored is that we have an inversion in the treasury yield curve. That is what was seen just before the global financial crisis in 2008. So effectively, where you expect the 10-year bond to fetch a higher coupon than the 3-year, you find the 3-year has a higher yield than... So when we were reporting last time, we talked about the 3-year. They say 3-year is a sign, but when you get the 2-year, also fetching a higher yield than the 5-year, then those are actual indications that we are moving towards a recession. Interest rates have remained fairly stable. Inflation rates have also been stable, but I think you have seen the latest, which, because we are only covering up to March, there's been a substantial rise in inflation rate. I think it's 6.94, 6.35% in April. A combination of factors, as explained by the relevant institutions, really more around increase in the price of fuel and anticipation of drought. Actually, even before the rains, the onset of these rains between January and March, there was substantial drought which increased the prices of mainly food products.